Hi, everyone. Thank you for joining us at the StashAway and JP Morgan Asset Management 2024 Second Half Market Outlook event. My name is Tiffany, and I'm from StashAway, and I'll be your moderator for tonight. So before we kickstart officially, let me first introduce our speakers for tonight. So first, we're very happy to have Marcella, Global Market Strategist from JP Morgan Asset Management. Marcella is responsible for formulating and delivering JP Morgan Asset Management's views towards the market to investors across Asia. Next, we're very happy to have Stephanie, our Chief Investment Officer. Stephanie has over 2 decades of experience managing global multi-asset portfolios for Goldman Sachs, institutional investors, and family offices. Before starting her career in finance, she started as a management consultant at McKinsey, and she graduated with a master's in artificial intelligence from Stanford University. Finally, Ronald, our Hong Kong General Manager, will also share a few words. Ronald is currently leading the overall business development and operations at StashAway Hong Kong. And prior to joining StashAway, he was a senior engagement manager at McKinsey Hong Kong and was mainly focused on giving advice to financial institutions on topics related to digital analytics and strategy. Now let's take a quick look at the agenda for tonight. So since most of you here are new to StashAway, we'll first have Stephanie and Ronald quickly introduce what we do. Then we'll pass on the time to Marcella and Stephanie to share the market outlook by JP Morgan Asset Management and StashAway respectively. We'll end with a Q&A session where you can ask any questions that you have. And please also feel free to stay behind for networking. Before I pass the mic to Stephanie, we invite everyone to scan this QR code, which will take you to our Slido site. So you can basically ask any questions that you have throughout the session, and we'll get to those questions at the end of the event. So we'll give a few seconds for everyone to scan the QR code right now. Thank you. Okay, I see that most of you have already scanned the QR code. So without further ado, let's pass the mic to Stephanie to introduce StashAway. Thank you, Stephanie.
Thank you, Tiffany. And I'd like to extend a very, very warm welcome to every one of you. I know that it's kind of 6:30, 7 o'clock, so you have a lot of choices in terms of where you want to hang out. But thank you so much for coming here and spending time with us. And hopefully we'll be able to add some value to your night. So it's like 2 hours well spent. First of all, before I guess Ronald talk about more details about StashAway, he asked me to speak a few words. I guess my name is Stephanie, and I am the Chief Investment Officer at StashAway. StashAway was started about 8 years ago in Singapore, and Singapore today remains our headquarters. However, we have operations not just in Singapore, but obviously in Hong Kong, also in Dubai, Malaysia, and Thailand. So what is StashAway? Oops, yes, here. I always like to pull this slide up as the first slide because we actually have John Tsang, the ex-Financial Secretary of Hong Kong, as our senior advisor and also spokesperson. And I think actually this image sums up what we do very, very nicely. We're basically your personal financial secretary. And I mean, you can see John dressed in all walks of life. We serve clients who are from different backgrounds with different professions, but we believe that everyone needs to invest. However, it's not so easy for everyone to start investing or find good investment solutions or investment advisors that you can trust. So StashAway was actually built with the mission of empowering everyone to invest for the long term. And how do we do this? We do this by building a full-stack technology solution. So you can easily access all our products, all our services through a mobile app that you can download from the App Store, which, of course, tonight will give you a special coupon for downloading the app and trying us out. We have different products, which Ronald will go into, but this is basically a few screenshots that shows you how simple it is to use our digital platform, which is available both on mobile phone and on the web app. And I guess with that, let me pass on to Ronald.
Thank you, Stephanie. So before we go into the topic about like market outlook, please allow me to spend a few minutes to talk about StashAway. So as what Stephanie said, we actually started in Singapore back in 2017, and now we're serving more than 100,000 clients across Hong Kong, Singapore, Malaysia, Dubai, and Thailand, managing more than 1 billion of assets. Of course, compliance is the core of our business, so we're regulated by like the regulator in each of the market, including Hong Kong SFC. We are backed by reputable investors, including Sequoia, Fidelity, Humanitarian, and SquarePeg. We are recognized by the Financial Times as the top 20 fastest growing company in APAC, and also as a technology pioneer by Economic Forum. We are featured in quite a lot of international and local media, from CNBC, Bloomberg, Now TV to Singdao Daily, talking about like our views in the market, talking about how we develop business across Asia, how a web-type solution is disrupting the market. So we go back to John. So many questions say why I should invest with StashAway, right? The very first answer is simplicity, right? You can easily create an account, make up your portfolio, see your performance in less than 10 minutes. Although you can do everything in the app, you can always call someone to help. You can call the CX, you can call a web advisor for any kind of advice or question that you have along the journey. Secondly, it's all about intelligence. Particularly in Asia, particularly Hong Kong, a lot of people think about like security trading, right? Which stock I should buy? Should I go for Tencent? Should I go for Alibaba or Nvidia, right? But what actually matters? 80% of the return is actually coming from asset allocation. And this is also how institutional funds manage their money. We want to bring this concept to retail, to everyone in Asia. We have no minimum, we have low lockup, you can always start easily. Our fee is also as low as 0.2%. Why we can charge such a low fee, right? Because we heavily leverage technologies and automation to make our business scalable across Asia. Lastly, we are definitely secure. We are licensed by SFC, including myself and a lot of colleagues here. Of course, our client monies are always separated from our operating money, so it's definitely secure. Another very common questions, right? How are you different from brokers, right? How are you different from banks, right? So talking about from a product, right? We offer a very simple suite of managed portfolio. And our investment team manage portfolio with a proprietary algorithm. In banks, you might have access to many mutual funds, but often you're more like in a supermarket model. In brokerage, right? Definitely you can trade stock, trade ETF, but you have no advice. It's mostly based on your own decisions. As a digital advisor, right, we provide advice digitally, right? With assessment, telling you which portfolio actually is most suitable for you. But at the same time, you can always reach out to a commission-free financial advisor who give financial planning advice based on your personal situation. In bank, definitely you can be able, especially in retail bank, you may get access to relationship managers, right? But the advice are based on many different factors, including commission. Talking about fee, we charge 0.2 to 0.8%, which is actually much lower than what you can get for a mutual fund product, which often charge 1.5 to 2.5% on annually, and also like 1 to 3% on subscription basis. So this is kind of the layout of our app. Everything very straightforward, easy. You can always create like a pick a goal, see your projection, see how much you should invest, see the progress of investment, and make like deposit super seamlessly. We have a very simple suite of product, but also very complete. From cash management products, from general investing is actually a flagship product who actually like multi-asset portfolio. We offer thematic options. We can also offer alternative investment in a much lower minimum and fee than traditional private banks. Talking about like two of our very flagship products, one is definitely like our general investing, which is actually a globally diversified multi-asset ETF portfolio. So that is also tailored or personalized based on a risk preference. We will manage your portfolio and also a strategic partner BlackRock, depending on which portfolio you go for. We do institutional asset allocation for you, right? So you're not about like picking which stock, right? But picking which asset class you should invest based on the economic regime and also your current financial assessment. And lastly, we do automatic rebalancing and re-optimizations. That point, like Stephanie will talk more how we actually do it exactly. Some very simple example of our GI portfolio. I don't go into details a lot, but every single portfolio, regardless of your kind of, risk level, is definitely well diversified across asset class and geography, and the return is also pretty decent. Another very popular product is actually a cash management product, US dollar cash yield, which offers 5.33% of annually. This product invests in short-term treasury with no lockup, no minimum. So a lot of clients would like to park their idle cash in this cash management portfolio. So lastly, right, it's a really short summary of StashAway. We have a special offer today. By scanning the code, you can download the app. And with the promo code SAHK Academy, which is also in the leaflet in your merchandise bag, we're offering 3 months of free investing for everyone. We're offering $50 Starbucks coupon if you download the app today for new clients. It's a very special offer, right? So it's a very short summary of StashAway. We encourage you to stay behind, schedule a call with an advisor to know more about us and invest with us along your investment journey. I will pass it to Ms. Sally for the market outlook.
Hi, good evening, everyone, and thanks so much, StashAway, for inviting me back. I was here late January this year, and what I want to do today is, given it's a mid-year, and we have just released a mid-year outlook, so I would like to give you guys a glance of what we think for the rest of this year. But first of all, let me introduce myself. I'm Marcella Chow. I'm the JP Morgan Asset Management Global Market Strategist. And back then, when I first came late January, what I want to show off a bit was what I talked about and what has happened so far. So back in January, we were talking, market was worried about recession, and then the Fed rate cut will be very imminent in March. And back then, we were saying a recession is very unlikely, and a rate cut will probably be not until end of the year. And see, we're now in the mid-year. Recession is not happening in the near term. We continue to believe a soft landing is most likely, and then a rate cut will probably just be happening towards the end of the year. We are saying probably a higher chance in December than September, and probably just one rate cut. And even for 2025, we believe 4 rate cuts, which is currently forecasted by the Fed, might be a bit too much. And we believe that the current rate cut cycle or the current rate cycle that we have seen recently with the rate hike will be a very fast and furious one that we have witnessed, but then the rate cut cycle will be a slow and cautious one. And as a reminder, this is JP Morgan slides that we actually picked up from our guides. So these guides are a quarterly guide that we release every quarter. And this is actually released in different regions. So we have on the right, you'll see it's like guide to market, so GTM. And then in the region, you'll see as US. So there's a guide to market US slides. You guys can find it from our JP Morgan Asset Management website. And you can refer to the exact slide number for the exact slides. And given the automation and also with the Python technological advancement, we have actually recently revamped all these quarterly guide to daily guide. So if you guys are interested to the latest update, you can actually go to our website and download, for example, US guide or the Asia guide from our respective websites for the latest daily updates. So just a recap of what has happened so far as we step towards the end of June. We see that according to region-wise, we see that US has actually been one of the outperformers year to date. And Japan is a very sought after for 2023. But then for a lot of foreign clients that did not engage into hedging, if we look at the local year-to-date performance for Japan under selected market, we see that it's still decent. But then if then in USD cost, given USD terms, given how with the yen depreciation, the dollar return has not been as decent compared to, for example, in 2023. And that's why we see that in Japan, the momentum has been receding. China is one of the lagger in 2023. And so far, year to date, has actually been quite decent, but then the confidence for the market remains quite weak. And in terms of today's 20-minute session, I want to bring out two key terms or two key themes that I want you guys to remember. Two key words. One is divergence. Secondly, is broadening out. So we see that for the rest of this year, a divergence will continue to appear. Actually, from what we see in US, we see a divergence happening within Magnificent Seven or the large cap technological companies versus the rest of the S&P 500. And also divergence is happening across also different global central banks. And then once divergence happens, we expect the rest to happen with a broadening out. So for example, just keep in mind these two terms for the rest of this 20 minutes. So for example, for US, we see that a divergence has been happening with Magnificent Seven, or so far, right now, market has started to neglect one particular company and call it Max 6 right now. And with Max 6, we see that actually, if we count the top 10 companies, or we don't focus on just those top 6, Max 6, with the top 10 companies, yes, valuation is quite rich at around 30 times. But then the rest of the companies, the rest of the 490 companies, are actually quite decent at around 19 times in terms of forward PE. So for the rest of this year, we expect other rest of the sectors, as economic growth remains quite resilient, that's going to broaden out to other sectors, other cyclicals. And don't forget, actually, even though the market focus has been on the Max 6 or Max 7 so far this year or in 2023, we see that energy companies, financials, and also utilities have actually been contributed quite a lot to the year-to-date performance in S&P 500. So for the rest of this year, we should also broaden out our focus, not just into those top 10 companies or Max 6, or actually into other sectors, especially as we expect economic growth to remain quite resilient, and also overall soft landing is likely to move forward for the rest of this year, and a recession is not imminent in the near term. In terms of inflation, yes, and at the first, this is one of the kind of thing that we may have forecasted. The timing was not as accurate. At the beginning of this year, when I came here, I was saying how I always believe inflation might be coming down very soon. But yes, it has been gradually coming down. But inflation has remained stickier than expected. But so far, we've seen that actually inflation is indeed coming down. And for Friday, we will likely see the PCE data continue to move down. And with weaker than expected, hopefully, data, that will suggest that we are closer and closer to the 2% target in terms of core PCE that the Fed targets. And right now, that will encourage the Fed to hopefully to proceed with one cut for probably for December. But one thing that is interesting is that we see that recent Fed speaks see that they actually focus more on controlling inflation rather than believing that recession is a key risk, because they believe that inflation is affecting more or broader of the well-being. Now, recession is a bad thing, and recession will affect people losing jobs, etc. But inflation is one thing that will affect the whole consumption cycle and the propensity to consume, etc. So this is one thing that they want to control, and even though it's been remaining quite sticky, and that's why they will continue to focus on the next few months' data to see that whether it's actually eligible for a rate cut. But because we believe that a few months' data before the September might not be sufficient for them to call for one rate cut in September, believe that December is a more feasible option. And this is one of the killer charts that we actually have within our Guide to the Markets Asia. Is on page 66. And this is one key chart that clients like. On the left, we see that this asset class returns following the end of rate hikes. So recall that the latest rate hike that happened was 2023 July. And so we are close to 12 months, and now is the orange bar is the latest rate hike cycle. Because it's not reaching 12 months yet, that's why we cannot count those towards the average bars, and then we add a particular orange highlight to highlight what happened so far. But if we look at the previous cycles and also the latest, we see that actually asset class returns remain quite favorable for both equities and fixed income. And a lot of clients might be wondering, oh, should I just park all my cash into all my in cash, all my assets in cash? Or recently, indeed, there has been fundamental supportive factors for gold, and so that's like another side discussion. But then we believe that equities and fixed income, especially at the end of the rate hike cycle, continue to favor both equities and fixed income. And meanwhile, as we embark potentially the rate cut cycle, we can turn our focus onto the right-hand side. This is not as easily observable on how equities and fixed income perform or how we should construct our portfolio when rate cut cycle begins. But one thing that we can reference to is to reference, because given how the key takeaway that I was trying to present today is that we are seeing still a potential soft landing scenario. So we can refer to on the right the dark blue diamond, which is a 1995 soft landing scenario. So on the left-hand side, we see at the end of the rate high cycle, most equities and fixed income outperform cash. But then on the right-hand side, as we embark the rate cut cycle, what is key is the economic fundamental of the economy. Right now, we believe that we are going to go through a soft landing scenario where economic fundamental remains very resilient. And so far, year to date, we see that it's not just US that economic growth has been more resilient. Actually, European recovery has been better than expected. We see that Asian growth has also been more resilient than expected. And that's why in the following pages, we will see that even with Asian equities, they have been actually performing quite well, and Asian high yield have been actually outperforming the market. And so, given how economic fundamental remain quite strong, believe that we can reference to 1995, and equities and fixed income will likely still continue to outperform cash in the next 6 to 9 months following the rate cut cycle. And especially within equities, we believe that as rate cut cycle started, the more growthy sectors, for example, communications services, technology, those that will benefit from valuation re-rating will continue to benefit. And in terms of global equities, not just we focus more on US just now. Recently, we got more clients asking about our view on European equities. And for European equities right now, we do see that the fundamental has actually improved quite significantly year to date, and the recovery has been better than expected. But after the European Parliament election and the calling of the snap election in France, right now we see there are certain political uncertainty that will continue to affect the performance of European equities. Even though we do see that European Central Bank continue to have sufficient toolkit, and then the European integration remains to be quite strong. But then in the near term, we believe the summer might be still quite volatile for both European equities and fixed income. But then, however, we see that in terms of valuation-wise, admittedly, European valuation no matter as relative valuation or absolute valuation, continues to remain very attractive. So if we continue to see any consolidation, it might be a buying opportunity, especially as we see European has actually syncing up to our theme today. We see that there's a broadening out because with US a focus on, for example, on technology, on AI theme. In Europe, we are actually more focused on like luxury goods, on healthcare. So it's more, the sector dispersion is much wider compared to US. So if the broadening out theme continue to work out for not just within markets and also actually within across countries, and as the political uncertainty dies down, as we get the result from the French snap election probably by July 7th, then we can have a more focused angle on the European fundamentals, which remain actually much better than expected. And in terms of Asia, we're still waiting for the positive catalyst to arrive, which is for the US dollar to weaken. Admittedly, year to date, US dollar remains strong, but then the Asia driver remains also to be, for example, from Taiwan, year to date, which has been one of the key outperformer, driven by AI and also the tech exports. And Korea was actually one of the underperformer, even though it's been supported by the AI, but then has been lagged by battery and by materials and also battery names that actually continue to drag. But also for Japan and Korea and China, we continue to believe that corporate reform that has been ongoing and that recently initiated in Korea should also provide some tailwind for near-term performance. And in terms of Japan, after talking about Taiwan, Korea, and Japan, Taiwan, Korea, right now, the focus is back to Japan. And actually, recently, both actually the macro fundamentals or macro momentum has been receding. In terms of macro figures that we've gotten, yes, in terms of equity-wise, first of all, we see that after outperforming and reaching 34-year new high, we see the yen actually reach 34-year low recently. And with the yen weakness, now it's approaching this threshold that market believes that the yen is too weak and we need to shift away from the weak yen for the market to stabilize. And in terms of macro, we see that so far the GDP number was actually weaker than expected. And also the consumption story is no longer as strong as people expected. So that's why we see that the macro momentum has been receding. But then we continue to actually remain quite supportive on the Japan story. First of all, because why did the whole 2023 Japan story came by? Excuse me. It's because of the Warren Buffett story, which actually he remains quite supportive of this whole Japan long-term constructive story about Japan. And so we continue to believe this will be one key supportive tailwind. Secondly, indeed, Japan managed to escape from the deflation territory. And going forward, one thing that we saw is that inflation remains something that the market continues to focus. And recently, the wage negotiation actually exceeded market expectation and came out with 5%. And one worry that market was concerned was that whether this can actually be brought forward or actually be initiated by, for example, small and mid-cap companies to actually also introduce wage hike. And that in terms will also a cycle and affecting people to increase the consumption given that they have higher wage and all started to buy properties and invest, etc. And indeed, in the latest data, we see the wage growth continues to be actually exceeding expectation. So that's the second good point. And thirdly, we see that corporate reform has actually been quite resilient. Sorry, let me just wrap up. Corporate reform has been quite resilient. Year to date, we see that the share buyback announcement has actually reached 9 trillion yen, which is actually close to 60% of the 2023 amount. And it's only year to date, and we are actually just middle of the year. So this is actually a very good advancement, and this suggests that corporate governance reforms and also continue to support ROE. And one thing that that we continue to focus is on the price-to-book ratio and the profitabilities of Japanese companies. Indeed, it's been slowly coming down. We look on the top right-hand side. When it first initiated in 2023, we see that the numbers that with percent of companies with PB ratios less than 1, which is not very profitable companies, account for close to 50% of the TOPEX index. But right now it's coming down slowly, and year to date we see that it's dropped to around 45%. The process is gradual, but then we see that companies are more willing to listen, and we see that companies are willing to listen to advices and reforms, etc. And this will continue to be another additional tailwind to support the long-term constructive story for Japan. And indeed, another key question that we continue to get is what happened to yen and the equity performance. We see that there is this negative correlation that when yen is weak, it tends to benefit the Japan equity market. And so when yen is weak, Japan equity tends to outperform. And this continues to happen in the past. decade or so. But then we see that the next step onwards will likely be central bank tightening for Japan because rate normalization, which Bank of Japan continues to be quite murky in terms of the communication. And that's another thing that keeps the market on toes because of the uncertainty that they see from the rate decisions from the Bank of Japan. But going forward, as we believe that Bank of Japan will continue to start hiking rates, but gradually, that will actually trigger yen to strengthen. And that will continue to see concerned investors whether with strengthening yen, will that cause the Japan equity to weaken. But we see that the negative correlation or the negative relationship has actually weakened so much more since 2021. And also, on another side, we see that Japan equities continue to be also supportive by, for example, exports. And we believe that even when Japan yen strengthen, it won't strengthen, or the whole process will likely be very gradual. And in terms of the Japan earnings will continue to be also supportive by another leg, which is the exports, which continue to be quite resilient and quite strong. So we believe that in the near term, even though Japan yen might strengthen a bit, but we do not believe that the negative impact will be that huge on the Japan equities performance. And also, right now, Japan equities continue to be supportive by the weak yen buy from the export side, which is continue to support to, on the right-hand side, the Japan earnings story. And if we switch gear and talk about another asset class, which is the fixed income, as we talk, when I first came over in January, I remember we continued to advocate as economic slowdown concerns. We should continue to add more of our portfolio to fixed income. This is what we continue to believe because right now, as we start to embark on rate cut cycle, even though we see that the Fed remains on hold probably until end of this year, but don't forget, actually, other developed market central banks have started to embark on the rate cut cycle. Back in June, early June, a few weeks back, we see that the European Central Bank has started its first rate cut. This is actually quite significant in that Europe actually tends to follow what the Fed does. But this time, the European Central Bank actually pioneered the first move in cutting rates. Probably because Europe is in a slightly weaker position in terms of economic growth momentum. Even though the recovery story has been stronger than expected, but then it's still comparably weaker than US economy, which has been very resilient. And also, a lot of actually the European rates are floating rates. And so when the ECB starts cutting, it will be actually more sensitive or actually be more beneficial to corporates and individuals. So that's why the ECB decides to embark on the rate cut cycle slightly earlier than the Fed. And with the rate cut beginning for different developed central banks, while the Fed, we see that as a diverging move, but hopefully they will be soon catching up. We see that year to date, another key phrase that we hear over and over again is a higher for longer rhetoric, which actually persists longer than expected. And while with the Fed, while we are expecting this rate peak to come down soon, the peak is actually gradually developing into a plateau. And if recall that just now I was saying how July 2023 was the rate peak of the last rate hike. Likely, if we persist until December, this rate plateau will be around 1.5 years already. So as this evolves, we see that with also economic growth more resilient, not just within US and also in Asia, we see that year-to-date performance for Asia high yield and also for US high yield continue to actually exceed expectation. This is because of quite modest refinancing costs and also with high yield actually less sensitive to all these interest rate movement and interest rate rhetoric year to date. And also because high yield reflects how actually economy both in Asia and also US have been more resilient than expected. But going forward, as we embark on this rate cut cycle, as more central banks start cutting rates, we believe that fixed income continues to be a key diversifier within your portfolio. First of all, because at the start cutting rate cutting, price will come up, capital appreciation, capital gains, and also income remains quite attractive from the fixed income perspective. But duration risk is something that we continue to monitor. We believe that around 5 years more preferable, and we continue to monitor, especially given the higher for longer potential rhetoric lasting longer than expected. So we do not advocate a super long duration at the current juncture, and so short to medium term might be in the near term a better strategy, especially if we do not yet have a very firm signal from the Fed about its rate cut cycle and also on the inflation outlook. So hopefully in the past 20 minutes or so, I give you a brief mid-year outlook for the rest of this year. In terms of global growth, we see that U.S. so far has been more resilient than expected, but we expect economic growth momentum to slowly slow down, but still remains quite strong. Europe-wise, even though it's picked up better than expected, near term in the summer, we're expecting somehow a bit more political uncertainty and volatility. But once we have more certainty on that front, we continue to see value in both European equities and fixed income. The risk-wise, definitely ongoing trade tensions, not just with US, but with Europe. That is something that will continue to concern clients and also concern investors. ESG is something like the hot weather climates that we've been experiencing in the past few days suggest that there might be some other supply chain disruptions that might come back up again, or potential unfortunate events like war, etc., that might actually cause further supply chain disruptions, causing inflation to remain stickier than expected once again. So these are some of the key risks that we continue to monitor. But then with the key theme of divergence and broadening out, we believe that diversification remains key, with both allocation to both equity and fixed income, and not just focus on US, but broadening out to other countries, and more focus back into Asia as US dollar weakens, and then capital flows will hopefully benefit more of Asia equities. And don't forget, actually, AI themes are actually also quite popular within, for example, for Taiwan, Korea, and also for China. And for fixed income, we continue to believe, in the near term, we believe that given economic resilience quite strong in US and Asia, high yield is a good, attractive income provider. But then once we see more softening in different economic indicators, we should add more investment grade as recession hedge. So that's it from me, and hopefully it was good sharing, and welcome Q&A later on. Thank you.
Hello. Yep. First of all, thank you. Thanks, Marcella. It's always our honor to have Marcella back to speak to us about JP Morgan's view. I've been a long-term consumer of JP Morgan research, always find it very, very insightful, so thank you. With that, without further ado, let us present our StashAway outlook as well for the second half of this year. I've titled tonight's presentation to be Putting Cash to Work. And as you see, as we go through the presentation, we'll tell you different ways of different reasons of why we think right now is a good time to put your cash to work. One phenomenon that we've I guess, observed within our client base is that a lot of people still have a lot of cash. Now, obviously, cash is still very attractive, right, with interest rates more than 5%. But, I mean, there are also other alternatives that you should consider for your long-term investments. So we have three parts to tonight's presentation. First of all, I'll just go through a very, very quick recap of what's happened in the first half of 2024, and followed by, of course, what we think the next few months will bring. And then lastly, which is the most important part, so please stay till the end, is how do you put your cash to work? So very, very quickly, a brief recap of first half of 2024. Now, this is a chart with a lot of colors, and I mean, the only thing that I wanted you to focus on is actually the last part, which is the year-to-date performance. What is interesting is that if you look at the colors of year-to-date compared to the colors of 2023, they almost look exactly identical. So far, what we've seen in 2024 was actually just a continuation of 2023. Leading the pack is actually large cap equities, which had north of 10% return. And at the bottom, we have high yield bond REITs, and I guess not shown here, but government bonds also lagged. Now, what's been happening? There's two, I guess, major themes that I would like to highlight for the first half of 2024. This is a chart that shows you the 2-year US Treasury yield. And as you can see here, everything seems to be moving in just a box in the last 6 months, or actually more than 6 months now. Kind of starting from fourth quarter of 2022, 2-year yield have gone nowhere. It's basically just a boring range. Even though there has been a lot of events that seems to have happened, right? You've heard, oh, central bank did this, inflation data did that. In fact, if we look at the 2-year yield, it hasn't moved that much. Why is that the case? As Marcella pointed to, we're not making progress in terms of inflation. So a lot of people talk about disinflation at the beginning of this year. That hasn't happened so far. Therefore, from a fixed income point of view, it's actually been pretty boring. What's much more exciting is, of course, AI. This is an exponential chart, which shows one company reaching $3 trillion in market cap. And I don't need to tell you which company this is. Everybody knows is NVIDIA. And that seems to be the only story in town. So, I mean, that was the last 6 months. And I mean, what do we see changing on the horizon? Actually, we see quite a bit. And if you look at this chart, this shows you our macro model. So for those of you who are new to StashAway, how we allocate asset classes, or how do we do portfolio construction, is by looking at where we are in terms of macro cycle. And our algorithm, our system, actually optimizes your portfolio according to different economic environments. So from a very, I guess, top-down point of view, how we think about macro environments is through these 4 quadrants. You can see that there's 2 axes. On one axis, there's growth. The other axis is inflation. And if you go from these 4 boxes, you can see that there are different labelings. It's very self-explanatory. So for example, on the top left-hand side, we have something called good times. In this good times period, growth is actually accelerating and positive, inflation is low. Now, of course, this is good times because companies actually make the most profit growth during this period. And there are other boxes as well. So as we move from low inflation to high inflation, then, I mean, we move into inflationary growth. It's still a pretty good environment. However, companies' margins start to get compressed, central banks start to tighten, and, I mean, returns start to deteriorate. Then what happens is that basically central banks tighten too much, so the economy slows down and inflation remains high, so our macro cycles actually goes into stagflation. And this is where equities start to struggle and bonds also struggle as well. From stagflation, you can go back to inflationary growth or go into recession. I don't need to explain what recession is, everybody here knows. What we've observed in the last few months is that the economy has actually moved from stagflation back into inflationary growth. And actually, this is good news because growth is coming back. So in April, what we did for our client portfolios is that we adjusted them. We basically put cash to work. So this is a chart that shows you our 3 different portfolios of different risk levels. On the left-hand side is our lowest risk portfolio. On the right-hand side is our highest risk portfolio. And what's quite common across these portfolios is that you can see that, I guess you can't see very, very well, but let me explain. Basically, we have a big portion of the dark blue here for the lowest risk portfolio. That's the cash equivalent. So in the old regime, in a stagflation environment, we have actually over-allocated to cash-like government bonds, which was actually giving us north of 5% yield. In our new regime, we've actually reduced our cash. So where did the cash go? The cash actually went more to equities. Equities is actually the purple portion. So in all our portfolios, we have global equities, which is the lighter purple, and US equities, which is the darker purple. So in all our portfolios, we've actually increased our equities allocation. On the top, you can see that we have gold, which is in yellow color. So in our portfolios, we still keep our allocation to gold, but we've also shrunk the gold allocation as well to make space for risky assets. The thing that we have kept still underweight is still government bonds, given reasons that we'll speak about afterwards. So this is a chart that shows you the year-to-date performance of global equities versus global bonds. Global equities on top, global bonds on the bottom. And very, very clearly, as you can see, global equities have returned close to 9%, actually more than 9% year to date, whereas bonds has actually returned negative 4%. And this actually goes back to the first chart, which show you whereby things are actually just not making any progress in terms of inflation. And I guess if we think back even further, in the last 2.5 years or so, I mean, markets have actually been quite volatile, right? We've experienced a pretty significant drawdown in 2022. This is a chart that shows you how StashAway portfolios on average have actually performed relative to our same risk benchmarks. On the top, which is the solid line, that's our average StashAway portfolio return, and the dotted line is actually the same risk benchmark return. So we've outperformed on the way down. We've also outperformed on the way up. So on average, our portfolios are outperforming benchmarks by about 7 percentage points. Year to date, our portfolios are up 4% on average versus 2% for the benchmarks. This actually, of course, differs from risk points. So the higher risk portfolios have a higher return, and the lower risk ones have lower returns. So that is a very quick recap of how we did and also what was the environment. Next, I'll go into the second half outlook. And actually, if anybody has any question, just feel free to raise your hand. You can stop me anytime. Happy to answer any question. Of course, we'll have Q&A afterwards as well. So I said that there's good news and there's good changes that we're observing. What is the good news? The good news is that we're seeing a recovery in global manufacturing sectors. This is a chart that shows you the Global Manufacturing Purchasing Managers Index, which is a very good leading indicator that tells us where the economy is going. And you can see that, I mean, this indicator actually fluctuates around the 50 line. Above 50 means that economies are expanding. Below 50 means that they're contracting. Now, you can see that there's a big dip that was during COVID, but swiftly recovered. And there's also another dip that was towards the right-hand side of the chart. That was 2022, 2023. What we're observing now is that, I mean, they're coming back. This line is actually coming back. And this is important because this is also very, very broad-based. So this shows you the same global manufacturing index, but by markets. So you can see that there's more green than red. Green means expansion, red means contraction. So for example, in Asia Pacific, we're seeing a lot more greens. And even in Europe, we're seeing some greens as well. What is notable is that, I guess, if you look at the global ones, I mean, they've turned green for the last few months already. So it's actually a recovery that we think is sustainable. Why should we care about this PMI? Why should we care about manufacturing cycle? Because if we're investing in equities, what ultimately drives equity return is earnings growth. And this actually shows you the chart that correlates earnings growth, earnings revision with the global manufacturing PMI, which is in yellow. So as the global manufacturing PMI actually start to turn, we can see that earnings, global earnings actually start to turn with that as well. So we think that this is actually good news for equities. And I think to Marcelo's point, previously broadening out of equity returns. The other side of the spectrum is, of course, inflation. We've delivered the good news. The not so good news is that inflation still persists. And this is a chart that shows you, again, input costs that are kind of the leading indicators for input costs. I mean, yes, indeed, they have come down. However, they're not coming down as quickly as the market has hoped or central banks have hoped. Why is that the case? What we did was we actually looked at inflation in terms of demand-side inflation and supply-side inflation. This is a chart I also showed a few months ago. Back then, we were arguing that, inflation is here to stay. And this is one key reason. When we look at inflation in different components, you can see that there's the lighter blue bars at the bottom. These are supply-side driven inflation. What is supply-side driven inflation? These are basically inflation caused by not enough things going around. So for example, if there's not enough oil that gets pumped up, or if there's not enough labor, this shows up as supply-side inflation. The other side is demand-side inflation. So the darker blue line, the darker blue bar is actually demand-driven. Demand-driven is relatively easier to tackle, right? The Fed can just increase interest rates, slow down the economy. Demand-driven comes down. And indeed, that's what we've seen, right? In the last 12 months or so, this inflation is mostly driven by demand-driven inflation. However, supply-driven inflation is actually still quite sticky. So that's why there's still a lot of supply bottleneck. And we think that this is actually mostly in labor. Why? Because we're seeing that still developed markets like US or even the UK still has a labor shortage. Again, this is a chart that we've shown for the last, 12 months or so. And we've tracked this data almost every month. What is this data? This is basically the US labor force going back, 10 years. You can see that this line has been quite consistent. But there was a big interruption in 2020, and that was due to COVID. So a lot of people actually left the labor force. Now, when we do a projection, which is the kind of lighter blue dots, we can see that if there was no COVID, we should expect the US labor force to be much higher than where it is today. So why did people leave the labor force and didn't come back? So during COVID, a lot of people actually took on early retirement. These people probably won't come back, particularly if they have enjoyed the equity market rally. Some people have moved from, let's say, full-time job into work from home, part-time job, starting to enjoy life more, so they're never going to come back. So for various reasons, actually, we're seeing a labor gap still of 2 million workers in the US. And this explains why inflation is still so sticky. So I think some of these can be helped. So for example, AI is helping to solve some of this problem. So perhaps we don't need the gap to fully close, but still it is a big gap. So the labor market has actually indeed been cooling down. So this is a chart that shows you US jobs opening versus unemployed ratio. So one means that for every single job opening, there's one person who's unemployed. So basically the whole labor market matches. When there's more people, when there's more job opening than unemployed, means that labor market is very, very tight. So we've seen that the labor market has actually been quite tight. It's become less tight right now. However, if you think back a few slides, we said that growth is actually coming back, right? The manufacturing sector is coming back. And when we run the analysis of job opening versus ISM, we find a pretty decent correlation. So as the economy actually picks up, there is more job opening, right? It makes sense because companies will start to hire again. So here we are. We have a economy that's recovering, a job market that is still quite tight by cooling. But what we think this chart shows is that perhaps in the next few months, the job market could heat up again because companies will start hiring again. And that creates problems for the Fed and creates problems for inflation. So that is why we believe that interest rate may actually stay higher for longer. Added to this, actually, central banks are starting to loosen monetary conditions. This chart, this map actually shows you on which central banks are starting to cut interest rates. The ones that are starting to cut are in blue. So more and more central banks are starting to cut. And more importantly, if you look at what the Fed does, they have announced that they will start to taper off QT. And that tapering actually starts in June. So from June onwards, because I guess previously the Fed has been shrinking their balance sheet on a monthly basis. But from June onwards, they're going to be shrinking less. So meaning that there's more liquidity going around the system. And that supports growth, of course, but also supports inflation. So we are currently in inflationary growth regime, and from what we've seen so far, all the data, all the analysis that we've done, we think that we're quite likely to stay in inflationary regime for the next few months at least. So what are other things that we should be thinking about in the next few months? Of course, there is the US election. I don't know what you think about Trump versus Biden. Whenever I talk to different people, people have different views and it changes all the time. The betting market, for your information, is now saying that Trump will win. So let's see. But I'd like to also remind everyone that political events tend to be quite short-lived. This is a chart. Have a guess what it is. But I mean, in the middle of the chart, you can see that there's a big dip and then a big quick rebound. This is actually India equity market. So for those of you who have been watching India, you remember that last month they had an election where Modi and the BJP actually lost a majority. The market actually crashed 6% one day, but swiftly recovered the next day. This is a chart that goes back longer. So the year was 2016. There were two dips, which I circle in red. For those of you who remember, first dip was actually Brexit. The second dip was Trump getting elected. Now, there was a lot of anxiety in the market about like all these political kind of new regimes. However, if you can look at, if you see kind of S&P return for, I guess, for the full year or even for like longer term, it doesn't really matter. And I guess one thing to remember is that ultimately, politicians care about voters. Voters care about economy. Therefore, politicians ultimately care about the economy. So it doesn't matter who gets elected. Ultimately, they will try to boost up the economy. So what do we do with all this, right? How do we find opportunities to put your cash to work? Of course, yield, cash yield is very, very attractive. Now, Ronald likes this chart a lot because I can help him to sell more of our cash management products. Today, if you put money with StashAway, cash yield is actually 5.33 per annum, which is very, very attractive because, I mean, we haven't seen this kind of level of interest rate for decades. Or NVIDIA. Is NVIDIA the only game in town? Like, I mean, Jensen is now God, so is that it? What else do we see? We think, yes, indeed, there are alternatives. So let me actually walk you through this chart. So we mentioned before that we think currently the regime is actually in inflationary growth, and we think this regime will persist for quite some time. And when we look at what performs during this regime, we find that, for example, US industrial equities actually outperform cash by 10% on average. S&P outperform cash by almost 8%. Global equities outperform cash by almost 7%. What underperforms is actually long duration US treasuries. So you already get 5% from cash. These are excess returns. So on top of that 5%, you can get even more returns by investing in different equities or kind of global equities. Now, of course, by investing in equities, there's a bit more risk, so you need to kind of be aware of the market volatility. But if you can ride through these kind of short-term volatilities, they will give you higher returns. And then the other thing, I guess, is that a lot of people are concerned about the equity rally so far because it's been highly concentrated. This chart shows you the market cap of the largest stocks relative to the rest. And I mean, the higher it goes, I mean, the more focused, the more concentrated the market is. Obviously, a lot of us know that the market rally has been focused on the Max 7. But I think what Marcella also alluded to is that valuation for the broader market is actually not that expensive. This is a chart that shows you the forward PE ratio, price to earnings ratio, for different sectors of the S&P. S&P is actually in the middle. You can see that we plot out the bar as a 10-year range. There's a dark diamond, which is the 10-year average, and the yellow dot is actually the latest valuation. Now, when the yellow dot is above the diamond, it means that it's overvalued. Where is it overvalued? We can see on the right, infotech is actually quite overvalued. Even the Max 7 itself is just slightly overvalued. Why? Because even with the rally, it's been supported actually by earnings growth by these biggest companies. And if you look to the left, I mean, there are plenty of other sectors that are not as expensive. So equities as a whole is not that expensive. It's just a few, I guess, a few sectors that are more, that are richly valued. So what do? At StashAway, we manage portfolios for our clients. Our clients also have the flexibility to select their own ETFs into their portfolios. We've recently did, as we said, a adjustments of our portfolios. I mean, here are a few new things that we've added to it. The first ETF that we've added is an equal weight S&P. As I mentioned before, S&P now is very, very heavily focused in a few stocks. Now, if you don't want to take a view on these stocks, an equal weight S&P is actually also a good option to get broad-based exposure. We also added U.S. defense and aerospace. We like this segment because of two things. Number one, it has a big overlap with the industrial sector. So a lot of the companies here are actually cyclical names that benefit from a re-acceleration in manufacturing growth. And also, given all the geopolitical kind of conflicts going on around the world, I mean, this is actually a good hedge versus those. Lastly, we've also added India. We like India as a structural story. And when we look at the earnings growth cycle for India, indeed, it is still outperforming a lot of other regions, particularly those in Asia. So we like India as a structural and also a cyclical allocation. We also like gold. Gold is actually a good hedge in a higher for longer environment. This is a chart that shows you gold return versus equity return under different market turmoil events. You can see that there's two bars, or two colors. The darker black one is S&P. So all these are market crashes. The lighter green one is actually gold. So you can see that actually gold prices are not so correlated with S&P prices when there's a crash. So it gives you protection when there's a crash, which, I mean, happens every once in a while. But also structurally, we think that gold is also a good hedge versus for dollars. On the left-hand side is actually the projection, I mean the US government's own projection of their own debt to GDP ratio. So I think a lot of us know that the US will actually issue a lot of debt in the next decade to fund its various government programs. And if you look at the projection that the US itself does, its debt to GDP ratio is going to expand from 100% to almost 200%. It is a significant increase in the next 10 years, which means that the Fed will have to, tolerate high inflation, print more money, et cetera, et cetera. So if you're concerned about this structural change in sort of the US fiscal condition, which, I mean, obviously we are, and also a lot of other central banks are, gold is actually a decent hedge for that. So lastly, I just wanted to, give you a snapshot of what are our ERAA allocations. I mean, ERAA basically stands for Economic Regime Asset Allocation. These are our different StashAway portfolios. So we have benchmark weights, which reflects our structural allocations across cycles. So if you go to like a traditional, retirement fund, they would have bonds and equities. Let's say a lot of people have 60% equities, 40% bonds. We're actually introducing gold into our structural allocation because of the structural concerns that we talked about. And also for the lower risk portfolios, we structurally introduce ultra short bonds, which are cash equivalents, given the higher for longer environment. So because if you go longer duration, they don't give you enough compensation for the duration risk. So these are our benchmark weights. I won't go into detail. Happy to talk about it after in Q&A. So I'm almost done. Stay with me for 2 minutes more. And I just wanted to walk you guys through a thought experiment. Some of you may have seen this before, but I've updated it for COVID. So we always talk about long-term investment, and we always tell our investors it's very, very hard to time the market. And you shouldn't time the market to try to get in. And let's just go through what happened during COVID. So it wasn't too long ago. It was January 2020 when like the COVID news first started breaking and markets cracked. So in a very, very short time during March 2020, S&P actually fell about 30%. Now, if you think back here, you were probably thinking, that, like a lot of people did, which is that, I mean, the world is never going to be the same again. Investing in equities is a very, very risky thing, and that I should probably cut everything and move to cash. Now, of course, the government came out with rescue programs. The Fed announced that they would actually loosen liquidity, and the market swiftly returned. And indeed, I mean, it has rallied so much that it was way past the peak before COVID. Now, if you didn't invest back then, or if you like kind of was thinking, oh, I'll wait, then maybe you would have missed the whole rally. And now it's October 2022. The market has corrected slightly, and imagine you were here. What would you do? Do you think that you would actually wait for the market to correct more to buy, or you would think that, I mean, now maybe it's a good time? It's very, very hard to tell. You don't know, because I mean, markets have actually rallied so much already. And market continued to chop around for a bit, right? It went up and then it went back down again. Now you're thinking to yourself, oh, should I invest? Should I not invest? What should I do? Again, if you didn't invest, the market kept going higher. So, I mean, the story here is that markets inevitably go through ups and downs, and sometimes it's very hard to time the market because you don't know what the next event would be, and the only thing that you can be sure of is that over time, the market goes from bottom left to top right. So what can you do? Fortunately for us, there's a very, very good tool, which is called dollar cost averaging. So if you use dollar cost averaging, basically the concept is that you set up an automatic deposit into your investment portfolios every month or as frequent as you want to. You only set it up once. For example, every month when you get your paycheck, you deposit some into your investment portfolio, just like a savings account. Then over time, you would be able to reap the benefits of an upward trending market. And the good thing about this is that you don't have to worry, you don't have to time the market, and also if you set a fixed amount, then I mean when equities actually come down or when stock markets come down, you can actually take benefit of that lower prices and buy more shares. If market's up, then you can buy like fewer shares. But this is actually a good kind of way to not to have to think about all these market fluctuations. So with that, key takeaways. First of all, a broad-based global recovery seems to be taking shape. That means two things. Growth is coming back, but also inflation could stay high for longer. Our own investment framework shifted to a regime of inflationary growth, and this actually advocates putting cash to work. We think the bull market should broaden out. We have overweights in cyclical equities, also in geographies such as Japan and India. Gold also remains a good balancing asset. Our general investing portfolios have posted pretty solid returns in 2024, 4% on average versus 2% for same risk benchmarks. And then lastly, if you walk away with nothing, just remember that when investing long term, it's not about timing the market, but it's about time in the market. So do DCA or speak to our wealth advisors, speak to us to see how you can get started. I guess, yeah, with that, thank you very much.
Thank you, Stephanie and Marcella. We hope that was very insightful for all of you. Now we'll head on to the Q&A session. So may we invite Stephanie, Marcella, and Ronald onto the stage, please. So for anyone who has questions, here's your last chance to scan the QR code. And please feel free to ask any questions that you would like to be answered. And you can also upvote any questions that you would like to get answered first. So to Stephanie and Marcella, we do have quite a number of questions, so let's try to keep our replies short and sweet. Okay, so the first, and meanwhile, while you're listening to all of the questions and answers, please feel free to download the app and test it out. We have the promotion that's very exclusive for all of you. Okay, so first question, where do you see digital assets fitting into your portfolio construction? Perhaps we can have Stephanie answer that question.
Yes, so I think digital asset is, of course, a very, very interesting topic. A lot of clients actually ask about it. We do actually have portfolios in Singapore offered for our accredited clients, which has Bitcoin and Ethereum allocations. So when we think about kind of digital assets, I think I think it's an asset class. Pretty much, if you think about Bitcoin, it's pretty much like gold. So it's a hedge versus other currencies. The difference is that it is a lot more volatile than traditional assets. So when you construct portfolios, you have to take that into account. And I think if you kind of run kind of analytics, it would show that for most people, having a single-digit allocation is probably in risk-adjusted terms, a relatively, I guess, aggressive way to allocate already. So in short, consider your risk when you invest in digital assets. Of course, we have ETF launches in Hong Kong, so these days it's a lot easier to put these digital assets into your portfolio. So, I mean, we're actually also looking at ways to include that into our portfolios as well. And yeah, I think stay tuned. We'll have more to share.
Thank you, Stephanie. Moving on to the next very popular question. If the expectation is for the economy to shift from stagflation to inflationary growth, why is the market still expecting or hoping the Fed to cut rates? I guess that would also be a question to Stephanie. And Marcella, feel free to add. Yeah.
So, I mean, the market actually shifted its expectation very, very quickly. At the beginning of the year, the market expected the Fed to cut 6 times. And as recently as, I guess, 2-3 months ago, the market was actually expecting no cut at all. Today, the market is expecting 2 cuts. Of course, I mean, there's not many months left, right? So I think the Fed can only have like 4 chances of doing cuts. We think that actually, I mean, the market is basically reacting to data. And data, especially inflation data, has actually been quite noisy. What we said at the beginning of the year is that we think the Fed has room to cut probably 2 times or 3 times at most, given that inflation is still sticky. Now, we think that as we get closer to the end of the year and it gets closer to election, it gets a bit trickier. So the window for the Fed to cut is not that, I guess, not that great. But it doesn't matter. At the end of the day, if the Fed actually cuts 1 time, 2 times, or 3 times this year, I don't think that matters too much for the market. What matters most is what they do next year. And we think there's actually a possibility that they would not cut at all next year, or if they actually hike interest rate next year, I think that would be a disruption to market. So instead of thinking about this year, I think we should actually start to think about next year already.
Right now, we're still thinking the next rate will likely be a cut instead of a hike. But yes, I do agree that inflation has been stickier than expected. But we believe it will gradually come down. But we do agree that inflation will likely stay above trend. And inflation will likely surprise more to the upside. And I do agree that next year will be the key to focus on. And just like what I alluded earlier on, we see that the recent rate hike cycle has been a fast and furious one, but the rate cut cycle will be a very slow and gradual one, as not just the Fed, actually other global central banks have been very cautious. Even with ECB, we see that they have started cutting rates, but then they say that there's going to remain data dependent, and depending on how the inflation turns out, they might actually decide to just cut 1 or 2 more times. And so this suggests that not just the Fed, actually global central banks all along, going forward, the rate cut cycle, even if it's embarked and started, it will likely be a very slow and gradual one.
Thank you, Stephanie and Marcella. Our next question is, how would you compare StashAway with discount brokers? The latter seems to have more product offering for users. I guess Ronald can take that question.
So we're actually quite different model, right? What we actually do is like a very simple suite of curated portfolio that is also personalized to you. For all portfolio, actually well managed by our investment team. So you're actually buying a portfolio of ETF that we automatically rebalance and we optimize for you. So it's actually very hassle-free, very simple. If you go to a broker, if you have only investment meal, definitely works, right? But sometimes you don't know what actually you want to invest. You don't know how to actually optimize your portfolio. So actually it's a choice, whether you want to invest or whether you want to trade. So it depends on you, depends on what you're looking for, investment or trading.
Thank you, Ronald. The next question is, the risks described in mid-year outlook are trade policies and extreme climate. How about geopolitical conflicts and elections around the world? And I think Stephanie briefly talked about it in the presentation, but if you and Marcella have any extra thoughts, please feel free to share.
Yeah, I guess with trade tensions, that actually also is one part of the ongoing geopolitical tensions that have been happening. And other than U.S. election that Stephanie has talked about, we had, like, for example, India election, and going forward we have European, like the French, and also going forward next year we have Germany going. So this will be an ongoing process, and political uncertainty will continue and will persist. But then what I think key is what we said just now, focus on economic fundamentals. And yes, we do think, for example, for US election, no matter who wins, we right now still forecast that it will be a divided government. And in the past, we see that even with divided government, and there might be some political deadlock going forward, but then economic performance and also equity performance actually has been quite resilient and has been doing quite well. So as long as the economic fundamentals remain quite sound, we believe that political uncertainty will subside and remain quite short-lived.
Yeah, I guess in my presentation, I showed a few charts where I said, like, political events actually don't matter that much in the long term. I guess one caveat to that is that, like, I think political these events create volatility in the short term, but these things would actually play out. These things eventually dissipate. I mean, what actually stays is kind of some of the more structural problems that, like, changes in political views bring. What I mean by that is, for example, take the US and China divide. And that is a political problem that is structurally changing how we think about globalization, how we think about trade, how we think about technology divide. So I mean, these things actually don't change with an election, because these are ongoing events that last for a long time. So when we think about political risk, we don't think about kind of one election per se, but we think about these structural shifts that are ongoing due to changes in voters' preferences.
Thank you, Stephanie. Next question is, which sectors shall we start looking into for both US and Hong Kong markets?
I guess we mentioned a few sectors. We actually prefer to broad exposure to cyclical sectors. Now, these include industrials. These include, for example, hardware companies. These include kind of the cyclical materials, energy. These part of the sectors, which are still, I guess, more reasonably valued. From a geography point of view, we also advocate, like, having a more diversified portfolio. So, for example, emerging markets could start to, like, look more interesting. I mean, even if you look at Hong Kong, China market, it started to bottom out. Of course, it's a much more gradual process, I think, just given that there's still a lot of overhang in the property sector. But if you look at, like, kind of particular growth sectors in the Hong Kong, China market, I think these are kind of where you can still find pretty good opportunities.
Okay, thank you, Stephanie. Next question is, does StashAway provide copy trading option? Are there any influencers to follow?
You want to answer? Okay. Copy trading option is still not yet available. And I guess the only thing that you can copy is my allocation. So, we actually allow our customers to actually do their customized portfolios using these templates. And these templates are actually our managed portfolios templates. Yeah.
Thank you, Stephanie. One question is, do you see a double dip recession coming?
Right now, I think the chance is getting slimmer and slimmer. But obviously, recently we do see some softening numbers, for example, in retail sales and consumer spending, etc. But the savings rate remains quite low, suggesting that they are still willing to spend. And also, there have been some offsetting factors, for example, with the recent wealth creation from this outperformance in U.S. equity market actually has contributed a lot of the older and richer generation, especially in the U.S. And those can continue to save and consume going forward. And also with the mortgage rate, even though we are staying potentially higher for longer, but then a lot of them managed locked in at a fixed mortgage rate. Actually close to 70% are still locked in a mortgage rate that's less than 5%. So these current high interest rates do not actually affect them. And so going forward, we still believe that we do think economic growth will slow down a bit, but then we believe that it's more likely a soft landing rather than a double-dip recession scenario.
Okay, thank you. Okay, we're reaching the final question. The app sounds very interesting. What happens to my money if StashAway goes bankrupt?
Yes. So basically, like all of our client money are kept in a custodian, i.e. in Citibank and Citi. So in case we go down tomorrow, all our client money is safeguarded with a custodian. You can always claim back your money. So it's very secure, very safe.
Okay, thank you, Ronald. So this concludes the end of our Q&A session. As mentioned, there is an exclusive offer for all of you who signs up for our app today. So for our new clients, there will actually be an extra $50 Starbucks coupon. And if you need any assistance with creating the app, our colleagues at the back are happy to help.
Yes, and please stay behind for networking, ask any questions about StashAways, and talk to the experts.
Okay, thank you so much for coming.